Good afternoon and welcome to the Wealth of Advice market update on the 12th of June 2020. Decided to do this update on the Friday afternoon again, just because it's been quite a turbulent week for stock markets, and I thought it would be good to come to you a little bit sooner, just to hopefully reassure people if anyone was getting concerned with what they may have read in the press regarding markets. As you can see from this graph here, the month of June started where May finished. We saw some good increases on funds and portfolios all the way up to the 8th of June there. And then we've seen consecutive days of market falls. This graph calculates things up till the end of play last night. Markets today have responded actually quite positively. The UK market closed up. Just checked there. I've got a graph I'm going to come to. The US market was up at 3% today. So it's turbulent times that we're back in again. What's caused the markets to become more volatile this week? Well, news stories that are coming out, which you might look at and think, well, that's quite obvious. We were expecting something like that. GDP in the UK is fallen by 20% during the month of April. GDP is the effective total output of a country. It's gross domestic product, the sum total of everything it does. So down 20% in April. Well, the country was on lockdown. What were you expecting? Why did the markets increase so much when we knew this data was likely to come? The Bank of England are considering implementing negative interest rates. As it sounds, it's just not good. It doesn't happen that often. There's one or two countries around the world who've already been going down this path, and it's not good. So hopefully, if they do that, it doesn't last for too long. We had a conversation with Franklin Templeton early this week, and they were saying it's encouraging to see that demand is returning to the housing market, but we should be wary that any autumn housing season is maybe going to be impacted by the furlough scheme. Typically, people will get their summer holidays out the way, kids go back to school in September. People will then look to move property and maybe put the house up for sale or look to purchase new ones around about that time. So with the furlough scheme being implemented for a few months at that stage and certainly coming to an end, as we know it in October, that may pose a problem for the housing market. People may just not want to move house during 2020. Who would blame them? And that could obviously have a negative impact on UK housing prices. The last bullet point there does talk about the UK furlough scheme. It's been up and running now for a good few weeks. Mentioned before, Wealth of Advice took advantage of it in the early stages. Most of our staff are back. The scheme does change from the end of June, whereby you can have staff coming back on a part-time basis. So I think that'll be a big help for a lot of employers. Some employers may look at it, however, and say, well, now may be the time to make staff redundant. We don't know. So that could have a negative impact on the UK jobs market. Big news this week. British Airways, EasyJet and Ryanair to take legal action to the UK government over the introduction of a 2-week quarantine period for travellers coming into the UK. Some people may ask, why is this only coming into force now? Why is it not being enforced since the beginning of the crisis? If you look back to March, there's data that shows a lot of people coming into the country who brought the virus with them. It's one of those ones where you look at it and you think, well, it's a strange decision that's being made. And from that particular sector's point of view, you can fully understand how it will have a negative impact. Travellers just won't want to come into the UK if they're going to have to quarantine for 2 weeks. So those three companies are talking about job losses. I know Heathrow Airport has announced that they're going to make significant job losses. That's not good for the government. They want to keep people working, because if you keep people working, you're avoiding the big, hurtful recession that may follow. The UK, we mentioned last week and the week before, we're trying to get the EU trade negotiations going again. We announced only yesterday, as a side story, it wasn't picked up by many news outlets, that we've decided to abandon the full introduction of EU border checks for goods coming into the country from January the 1st. That was something that the Brexiteers were really behind, because you have more control of your borders. It means that UK companies will be able to produce more goods, because it'll be difficult to get more goods into the country. But the UK government has looked at this and said, well, if we've got problems because of the coronavirus, why would we further hurt ourselves if we can't get essential goods and items in from January the 1st? Does this mean that a no deal may be likely, and they still want the ability for Europeans to be able to get goods into our country? We shall only see. Boris Johnson apparently is going to get behind the EU trade negotiations next week because they have stalled. Hopefully the Prime Minister getting in charge of the situation can push things along. We definitely need to see some movement on that, and that will be a positive for stock markets in our country. News from around the world. Everything seems to be focused on what's happening in the US at the moment. There's a lot of negative stories coming out of the US. I watched the governor of New York do a news conference last night. Some of his slides I'm going to show shortly. But the US decided to come out of lockdown sooner than what a lot of people said they should have done. The stock markets in the US fell massively this week. The S&P did reach a positive situation earlier on in the week from January the 1st till then. It had gone obviously down as it did, and it came back and it was positive. However, by Thursday the markets fell sharply. Yesterday was the worst day for markets since March the 16th. Last night, as I was watching the closing bell on Bloomberg, it was worrying to see that the Dow Jones was down 6.9% in one day. Worst day, as I say, since March the 16th. What's causing that? Well, the big fear that we have in the UK and Europe and parts of Asia is this second wave that's going to potentially come, and that could bring markets down when we have a second wave. Well, the problem a lot of states have in the United States of America is they've never gotten to the end of the first wave yet. New York State has seen a massive decline in its infections and people passing away, but other states are still seeing a week on week, month on month increase in the people who have the virus. That's got to be worrying for markets, hence the reason markets fell so sharply yesterday. Put this in there, as you can see we've copied and pasted it from the FT's website. It doesn't look like the rest, but we just did this in the last hour or two, and it shows that just after the US markets opened today, so that market was down 7% yesterday. Immediately people were buying the market when it reopened, and it was up 3%. I think that was by about 3:30 this afternoon. I don't know what the exact number is today, but the point is, you can look at one morning's news stories and think, God, that doesn't look good. The US market's down 7% in one day. Well, it can bounce back very quickly the next day. What's prompted that buyback of the market? I'm not 100% sure. What I thought we were seeing over the last few days was perhaps some technical reasons as well as to why people were selling the market. Imagine these big investors who bought the US market at the end of March going into April. They've made a hell of a lot of profit up to the beginning of this week. You start seeing some negative news stories coming out about the virus rate not going down. For those investors, it's a great time to sell the market, bank some profits, and then reinvest at a time when you're getting back in. So the person who was lucky enough to sell at the beginning of this week and reinvest today has probably made 10% of their investments by doing that. Obviously, we're in it for the long term. All of our clients, we talk about being in the market for a long time, not trying to time the market, but being in for a long time. We won't do that, but obviously you're going to suffer the worry of the volatility that comes through from that. When we talk about the US and how, as a country, they don't have the virus under control, these are some charts which the governor of New York showed last night on his presentation there, and you can see how it's come down over the last few weeks. If you look at the graph that Matt Hancock put on the BBC News yesterday, all news channels he was on yesterday, I saw him do it. The graph for the UK looks very similar to this. The US started opening their economy from May the 15th, and New York was the only state which has really continued to see its virus numbers fall after that. If you look at some of the other big states on there, California has a GDP in the top 10 of GDPs in the world. California is absolutely huge. And as you can see there, when people talk about a second wave, well, they've got to get to the end of the first wave. Florida, I mentioned something about Florida last week, about how they're planning on opening their theme parks again. Disney's opening, I think it's the 11th of July, Universal and such like opened last week. So they're wanting visitors to come to that state for all the tourist attractions and such like. And as you can see from the red line at the end of their graph, their rates of infection are spiking again. Texas has never gone down. Arizona, another state there where it's increasing. So that's just four that we picked from a multitude of slides we could have put in, just to show you that the biggest economy in the world, which underpins how clients' investments in our country and all countries on the world will go, because if the US market falls, every market seems to follow as well. They're far from out of the woods yet, and you've got to be sort of hopeful now that we do get some kind of vaccine, we do get some kind of cure coming from this, where if you are hospitalised, you're less likely to pass away from it. Various governors and people around the world will say, well, we do now have more testing, so it's obvious that the numbers of people who have the virus will increase. Only time will tell how this will affect the markets, but it's a reason. It's why the US market, the Dow Jones, fell by the amount that it did yesterday. It had its worst day since March 16th, and that's the reason why. Again, just looking back at the main portfolios that our clients use, the Royal London portfolios, we put up again, as you can see, the blue line, the Royal London Government Portfolio 5. We'd said in previous presentations, the one that has the most stocks and shares in, which is the Government Portfolio 5, would get above par from being the height of the market crash all the way through. And that happened last week, but then, as I say, we've had a few negative days thereafter, and it's just gone negative. It's only negative by minus 0.9%. If you look at the performance of those portfolios over 12 months, they're all in a positive position now. That's the state of play over a full month period, just the last month alone. So again, negative week, but positive over the longer terms. The risk score 2 and 3 portfolios, the main bulk of our client money is invested in these two portfolios. Not a good week, certainly down a few £100 from the close of last week to the close of this week. The portfolio that has the most stocks and shares in, which is the risk score 3, is still lagging behind the risk score 2, again from this notional £100,000 invested at the start of the crisis. Are we likely to see the continuation of a downward trend over the next few weeks? We're not sure, but the markets would have to go somewhere to fall back down to the levels it was at on the 27th of March. That figure there for the risk score 3 portfolio, 79,959, a 20% fall from top to bottom. Are we likely to see that again? I just don't see how it's possible, given the financial stimulus that was put into world markets at the end of March, which saw the markets rise. There's just so much money in there that markets will be bought. The bad companies have been sold. Their share prices remain low. So they've got nowhere to go. The companies that have done well through the crisis, the companies that have made money, their share price has come back, is high. People are still buying those shares. So the negative news stories which came through this week, you will still see over the coming weeks and months. And a slide we should perhaps put in again next week looks at how markets recovered from when the Lehman Brothers crashed in 2008. It took 6 months really for the market to stabilise after that, whilst I think it was about 9 months before you were back on par. That 6 months after, it was like a heart rate monitor going up and down until it got back where it needed to be, because certain news stories will spook the market. So thanks for listening to us again. Not a positive week for investment returns, still positive over the long run since the end of March that we are in positive territory. Again, looking out for some positive news stories next week, and hopefully, as I say, I can give you an update then with something more positive. Thanks for listening.